Kalen. Kalen has written in. Kalen has an ARM loan. It's currently at 3 1/8%, but he says it's adjusting in December, and he wants to know if he should do a HARP loan. He also has a second mortgage behind it. Kalen, first of all, adjustable rate mortgages have gotten a ton of bad press in the last 5 years, and I think it's a complete misunderstanding. There were two types of adjustable rate mortgages. I'm going to do this real simple and real fast. There were what we called the subprime style, which those were usually written in, they called them 228s or 327s. They were fixed for 2 years or for 3 years, and then they started adjusting. Originally, these loans were designed to bridge people over from some credit issues or some qualifying issues, get them into mortgages, they keep their nose clean for 2 years, they refinance into a traditional mortgage. Well, in the midst of all that, the market collapsed. So a lot of people got stuck in these 2 and 3 year loans that had huge adjustments because their margins were so big. I mean, we're talking about margins of 4 to 6 points. A margin, if you don't know it, is the addition they do to the index. So your typical home loan is maybe attached to a 6-month LIBOR is the index, and then they have a margin, which you call that the profit for the bank. On a traditional loan, which I think Kalen probably has, it should be a 2.25 margin attached to a 6-month LIBOR, which if you do the math today, Kalen, that's going to put your rate in and around 3%, maybe 3 1/8 when they round up to the nearest eighth. And so if you're looking at an adjustment in December, you probably won't adjust. And I think that's the key here, what point I was trying to make. Just because you're in an adjustable rate doesn't mean they adjust up. They adjust down also. And right now, all the underlying indexes are so low, Kalen, if it was me, I'd probably ride it out. See, you'll get a letter from the bank letting you know if something's going to change in your payment. I would write it out because right now these HARP loans are pricing out in the 4.25%, 4.5% range. Well, you're going to take an unnecessary interest rate jump. And also keep in mind this program, Kalen, lasts until December of 2013. So if you get a little nervous or if your payment's actually going to go up, then you should look at refinancing at that time. But right now, if I were you, I would just keep the ARM, enjoy the low payments, and just stay alert to those indexes. And if they start going up, then it's time for you to make your move.